Rich Krafchick, Cobblestone Asset Management. Sitting here in the middle of 2025, and there has been no shortage of action in the world to keep us busy, as usual. The purpose of this video is to tell you about a country rotation sleeve that we've recently added to our tactical portfolios. It's something Eric's worked really hard with me on, and I think it's only fitting to let him dive into some of the detail and the nuance of that. I just want to tell you that there's so many different ways to splice the market. There's large versus small companies, growth versus value. One of the more interesting to me has always been country. When you think about why, from one country to another, you have a difference in culture, difference in industry and composition that makes up a country. You have different currencies, and as a result, you have a wide spread of outcomes happening across countries in the world. Before I turn it over to Eric, let me just give you a quick recap. Some of the action that we've seen year to date, and it's been a busy year. So we've seen trade policy rapidly implemented, and we're really seeing three different outcomes from this. So some countries, they make a unilateral deal, and the U.S. and that country have solved the trade issues. Other countries, we've seen deferring of the trade issues. And then the third case, we've seen some implementation of tariffs. Some of that implementation has been short-lived, some of it stayed around a bit longer, but in each case, we're watching and we're making proactive and reactive adjustments as this is happening. The other thing we've seen here, a lot of tension in the Middle East. That's probably an understatement, but with the recent Israel and Iran conflict, we rapidly acted to reduce risk in your portfolio. And the reason why, it's one of those situations where it just makes sense to reduce risk, wait for the situation to develop, and then as we know more, we can make intelligent allocation decisions. So that's what we've done. We're still sitting with slightly less risk than your benchmark today. And the reason we do that is we keep valuation and overall market level in mind as we make these risk decisions. So you think about where we are. The U.S. market, the S&P 500, is near all-time highs. Valuations look a bit stretched. And when I say valuations, there's many different ways to look at it. I like the PE, so price divided by earnings. That PE ratio right now is over 22. So it is high. It's not to say that the market can't go higher, but we have this hurdle that's climbing where companies are going to have to outperform lofty estimates. We're going to have to see positive news surprises, and it gets tougher to continue that pattern of outperformance. So we're aware of that as we're making allocation decisions. All right, that's your high-level overview. Eric's going to take you through the nuance and just explain how we built this portfolio, why we're using it, maybe touch on why now. If you want the detail, you're going to get it from him. He really likes this stuff and he's great at it. And if you've heard enough here, go ahead and stop. Thank you.
Hi everyone, my name is Eric Jackson, and as Rich said, we're going to be diving a bit deeper into our country rotation sleeve today. We've been working on this for over a year and just felt now was the right time to get it to work. So if you've logged into your accounts recently, you've probably noticed about 10 new holdings in there, and that's part of this new sleeve. So we wanted to shoot a video and run through why we felt the need for this sleeve, how we run and manage the sleeve, and then we'll spend just a little bit of time on why we felt now was the right time to get it to work. All right, with that being said, let's dive in. So why did we make a country rotation model? Traditionally, international exposure, whether it be developed markets or emerging markets, comes from broad-based indices. These indices are market cap weighted, similar to the S&P 500, where the larger economy or the larger nation get a larger portion of the index. So if we look at the EAFE index, which tracks developed markets around the world, we can see that 4 names top the list: Japan, the UK, France, and Germany. They make up over 55% of the index. If we look at emerging markets, 3 names top the list: China, India, and Taiwan. They equal over 64% of that index. And this is where our sleeve comes into play. What if we made a sleeve based on valuation or expected returns rather than simply the market cap of that country? So with that being said, let's take a look at how we actually decide which countries go into that sleeve. So we've talked about why we created this sleeve. Now let's talk about how we actually implement the strategy. For starters, we needed to build our investment universe. We went out and found country-specific funds. From there, we needed ways of evaluating and analyzing each of these countries. The first way we do that is using PE. Rich touched on it a little bit earlier in this video, but it's just simply price divided by earnings. On a high level, we take the historical average PE and the current PE and we compare the two. If the current PE is meaningfully higher than the historical average, we consider that overvalued. If it's meaningfully below, we consider that undervalued. The more undervalued the country, the more likely it is to be selected within the model. We then use Grinnell-Kroner, which is a way of calculating expected return. It breaks the expected return down into smaller pieces, such as GDP and GDP expectations, inflation, dividend yield, and earnings growth. The higher that expected return, the more likely it is to be placed in the model. The final way is using CAPM, or Capital Asset Pricing Model. It's similar to Grinnell-Kroner in the sense that it calculates an expected return, but it uses different variables, such as beta, the market risk premium, and the risk-free rate. The higher the expected return, the more likely it is to be placed in the model. Once we have the data for each of those models, we then run an optimizer to determine which countries belong in the models. Once we have that, we then put it all together in an equal weight portfolio that builds the country rotation sleeve. Now that we've covered that, let's dive into a little bit more of why we decided to implement it now rather than when we first built it. Now that we've discussed why we build it and how we build it, let's focus on why we chose to implement it now. The first reason would be pure valuation. The valuation of the US versus the valuations of international markets. International markets appear to be more attractively valued. The second reason, and you can see the chart on your screen, when one begins to outperform the other, that trend continues for some time. We believe this could be the beginning of international outperformance. The final reason, we need to look at the foreign exchange. So when a foreign nation's currency appreciates, or let's say the US dollar depreciates, which is the situation we find ourselves in today, the returns of international markets are enhanced when the US dollar depreciates. Essentially, their currency can buy more of the US currency, adding to the total return of a US-based investor. So we've covered why we built it, how we built it, and why we chose to implement it now. If you have any further questions or want to see the model itself, please reach out. I'm more than happy to dive into it.